Guys, how's it going? Today I just want to talk about Intel and TMDX. These are two stocks, I've been just kind of looking at after their earnings. TMDX I've been following for a little bit of a longer period of time, but Intel has been getting more interesting because it's gone down a lot. So is it a value trap? Is it a falling knife? We just want to talk about that today, and I want to talk about if TMDX is still too expensive at this price because it's had a huge run up, but the fundamentals have gone better and better every quarter. So is it still worth a buy? Let's talk about it a little bit. So I just want to start with Intel first, and you can see that part of the reason for Intel, I think everyone knew the revenue was going to go down, but you had that huge gross margin reduction, and the EPS is basically non-existent. Now this comes at a time where things like AMD and Nvidia, which Nvidia is going to report later this month, but AMD had a very, very good quarter, and people can justify their crazy valuation. Intel, people just aren't liking what they're seeing right now because I'm going to show you, but the crazy capex with the foundry stuff and the negative cash flows for now. So it's just not looking good. So part of it is cut off over here, but basically what I'm just trying to show with the slide is that they do have some profitable segments. You take a look at the operating income, which obviously is declining for these other segments. But you can see that they do have some silver light at the end of the tunnel in terms of their other products, right? For the CCG, DCAI, and X. So they have some good stuff. Now the foundry, which is a total kind of sinking ship in the short term until they can, this whole facility gets built out. I think the facility cost is going to be something like, I heard, like 150 to 200 billion or something. So some crazy capex costs are going to need to go up with that. And you can see why people are kind of skeptical, because it's like you can't even necessarily guess what kind of cash flows are going to come from all that capex spend. But like they're saying over here, they're going to build a sustainable supply chain in the US, and that's kind of, I think, what people are looking for in terms of like geopolitical things and the government, right? They don't want to go to TSMC. They want something in the US. So there's some sort of incentive there. And, with the subsidies, I think it's possible they can benefit from that, right? Even with all this shittiness going on in the business. So you can see that they're doing a shit ton of like cost cutting, right? They're cut costs by like 10 billion, which is going to include, that 15% workforce reduction, 15,000 jobs, which is massive. So part of that is stock-based compensation is going to go down too, and the capex spend where it's not needed, it's going to be cut, and it's all full throttle with these other capex spends. So we'll see how that works. And I think it's very hard to make valuation for this because revenue's going to decline probably in the next year or two. It's not exactly clear, maybe break even at best, but it's not exactly clear what kind of cash flows they're going to get in the future, right? So I just want to look at maybe some like optimistic assumptions, because we know what kind of free cash flows they've done in the past, what kind of range they've done, and we can kind of guess what extra free cash flow is going to be done with this foundry stuff. So I'm saying let's say they can get back to like 10 to 12 billion dollars of free cash flow, like they did in previous years, then I think they'll be in a good position. We'll talk about that. So, my good assumption is going to be, they get back to these previous levels of free cash flow eventually. And I think they can do it. It's just a matter of weathering the storm and looking at whether they have the cash balance to do it. And I think they do, but it's still a risk. We just look at the current assets versus liabilities. I've been seeing some stuff around where people are saying, it's the price of Intel, with the stock right now, I think it's like 90 billion or high 80 billion market cap. It's close to basically the tangible book value of the actual business. And like, if you just look at numbers wise, yeah, that basically is true. But I think we got to be careful here, because if you look at it, all these plants and equipment, it's not, I don't have the expertise to say what percentage of the tangible book value that'll be actually worth, but I kind of doubt that it's worth what it says it's worth. It's probably a higher percentage of that. They also have a lot of goodwill, which is like brand value, and it's not exactly clear how much that's actually worth in cash. So if you strip out those things with all the losses that are going to come in the next 2 years, for sure, I think most people can say, I don't really think it's really that close to tangible book value. But I can see where they're going with it. They do have a lot of assets. It's just not exactly clear what these assets are actually worth, because a lot of it is, like I just said, intangibles. But there's nothing wrong with his balance sheet in terms of, for now, they're not, going to run into any issues unless something crazy happens. So it's a decent balance sheet. My sheet got cut off over here, but I'm basically just trying to say, well, what can they really make off the foundry? Maybe look at TSMC. TSMC is making like $13 to $15 billion in cash flow with a bit more capex. and we have a vested interest in domestic production, so it's not like a far-fetched to say that they could get like a premium for some of these products. So I don't think it's unheard of to say that. And I also read some analyst reports. I mean, if this all goes through, I think we can say it's going to be like, we can say that at the very least, I think we can say that they can make similar amounts to TSMC in cash flow, right? And think about, this is like a couple $100 billion of TAM. Really, there's only like 3 companies doing this right now, and in the near future are going to have the production capacity to do it. So it's not like an industry where competitors can just jump in without insane amounts of capex spend. That takes a lot of time and money. So with the 15% workforce cut and the dividend cut, they did save a decent amount of money. Just off that dividend, I think they're going to be saving around $2 billion, which is really good. So in a good scenario, like I said, if we go back to that $10 to $12 billion of free cash flow when capex dies down a little bit, and we can get to like $12 billion in free cash flow from those future investments on Foundry, we're talking like $23 to $25 billion in free cash flow. If you look at the historical average for this business, now granted it was growing then, but if we can get back to like slow growth, and again, these are all like very optimistic things. I'm talking about when they produce cash flows, when they, their growth maybe starts to at least flatline a little bit and not decrease. These are all at least 3 to 5 years out at least, right? So, I mean, if we assume a price to free cash flow of 13, which is like on the lower end of their historical average, we're talking like a $325 billion market cap without any future dividends. So that's like over a 3x from here. That's over $6 a share. But like I said, I took some very good assumptions. I said that they're going to make as much as TSMC because I think TSMC has similar capex costs. So there's really a long runway to even get there. And it would be a 3x if they can get to that point, maybe even more because the market might give it a premium because it's American, right? So I think if you want to buy that today, it's not terrible, right? But like you're really going to be waiting for a while before I think any legitimate fluctuations in prices, unless there's some crazy geopolitical event that happens, with TSMC. I just think it's probably not. If you want to, put a small position in here and just let it ride for a couple years, you might do well. But I think really the risk is more than the upside here in terms of, they got all the spending they got to do. But then again, there's a vested interest to keep them alive, right? Because the government's going to want Intel to be successful in this. And the upside is, like I mentioned, a 3x. And I don't necessarily think if they finish the project, that's like unfounded free cash flow. So I don't necessarily think it's a good buy, but I don't think it's a bad buy either, if you know what I mean. I think it's just decide to put some money in. I think just be prepared to wait many years. So that's that. Now, I want to talk about TMDX. Very interesting stock. It's almost up 2x over the year, especially if you bought at the lows in 23. Insane, absolutely insane business. Absolutely love this business, So they really have the only FDA-approved technology for lung, heart, and liver transplantation indication in the US. Now, with these like hyper-growth companies that are growing super fast and, they're just more recently becoming positive, I kind of hate looking at like forward PE and PE because it's just really unclear what that will be, because you can have like triple-digit EPS growth, like insane earnings growth just because, you're starting from negative or like maybe like 0.01. So I just want to look at a few different things and discuss it, right? So like I mentioned, with all these transplants, they were talking about, I think in the last quarter when I was listening to the earnings call, they were saying that 2028 they can get to like 10,000 NOP transplants, which is crazy, right? So, right now, if by the end of 2024 they can get to like 3,200, which is my assumptions, and I think their current price to sales is like 140, is 14. By 2028 they were saying you can get 10,000, so that's like, that's probably just a sub $1 billion in revenue and a $14 billion market cap. That's a 2.5x from here in 4 years, which is incredible, right? You're beating the market by a lot. But that's baked in with like a 20% plus to 30% plus growth every single year on average, which is obviously they have a very strong moat in that FDA approval. But I mean, is that realistic to think? And I just don't necessarily know enough about the industry, but I could see it happening. I mean, it's been happening for even a higher growth from in the last couple quarters. So yeah, so I mean, just on a price to sales basis, that's over 2.5x. And if we look at kind of more interesting things, right? At the end of this year, we're talking like $450 million in revenue, probably going to beat that. Analysts have it for 25, sub 600 million, 700 million, and by 28, it's going to be like just under $1 billion. And if you take a look at the EPS, they're saying it's going to be like $3 a share by 2026. If you look at today's price of like 160, that's still like a forward PE of you know, what is that, like 160 divided by 3, that's still like a forward PE of like 53. So you know, that's pretty interesting, and that includes the stock-based compensation. If you also look at the free cash flow, they're saying by the end of 26 it's going to be like 130 to 140 million dollars of free cash flow. So you can see at like I think it's like a $5.3 billion market cap, so trading at like 50 times free cash flow. But again, this business is growing just so fast. Like I showed you the revenue. But I think way too much of this valuation personally is just based off like this insane growth, and I think the stock is just really priced for perfection. I don't think it's cheap, even with this amazing growth. I don't think it's cheap if you look at the forward earnings. And if something is off just by a little bit, something legal happens, I think the stock can really fall a lot. And so it's obviously an amazing business, but I just feel like it's very richly valued. If you're holding it, if I was holding it, I mean, I probably wouldn't mind keeping it. But I think buying it here is there's just more downside than upside. If you looking at it on a forward earnings metric or even a price to sales metric, I mean, it's just super richly valued. And it's not exactly clear if they can keep growing their earnings at such a rapid rate, because they just recently got the positive EPS, positive free cash flow not too long ago, right? So clearly an amazing company, but I think you know, it needs to come down to reality of it. If I was actually the company, I'd probably issue shares right now, especially, you know, with the fuel costs and you know, their airplane leasing costs and all that. Like I think some extra cash in the bank now that they have such a which I don't think most people disagree, a rich valuation. I think that extra cash would really help them. So you know, in conclusion, Intel, I don't think it's a bad buy. I don't really think it's a good buy either. I think it's just more of like a wait, see what happens for now. TMDX, insanely good company, super good company, but the price on the company, I can't really see how to get there, and I can't see how to get there for like at least like 3 years, even if they grow pretty fast. So right now it's a no for me, but I mean, they might surprise again, you know, some crazy earnings growth, and I could very well be wrong. So yeah, that's just all. These are two very interesting stocks, and that's all.